If you have ever travelled to a foreign country, you may have needed to exchange your money. If so, you have already participated in Forex trading. Forex is the short form of foreign exchange. Well, Forex is a bit more than that. For example, companies buy goods from other countries. In order to buy them, they need to obtain the local currency first, just like us when going on holiday. The difference is they will exchange huge amounts. When these companies exchange these huge amounts, they will actually move the price because the demand for the currency that they need increases. When the demand increases, the price increases. With all this exchanging going on around the world, the exchange rates constantly move. This is how it works. When currencies are exchanged, they have a certain price, the exchange rate. As in any market, the price of a currency is determined by the law of supply and demand. If there are many people or companies that want to change euros into dollars, the price of the dollar will rise against the euro, and so the exchange rate will change. Let's use an everyday example to explain how you can actually profit from this. Say you live in Europe and went on holiday to the United States. Let's say that you changed your 500 euros into US dollars at the rate of $1.4 for every euro. You got 700 US dollars, but you do not spend any money at all. So you still have $700 after you come back. After the exchange rate moved from 1.4 to 1.3, instead of getting just 500 euros back, you actually get 538.5 euros. You have gained 38.5 euros simply from holding your money in dollars while the exchange rate changed. This is essentially how we trade in the Forex market. We buy a certain amount of a currency, hold on to it whilst the exchange rate moves, then change it back, making money along the way. How to decide when the right time to buy and sell is exactly what we teach you throughout the rest of our learning lessons. As you can imagine, traveling a lot and saving a bit of money on your holiday budget and then exchanging it, it's not really a practical approach to trading currencies. Fortunately, there is an easier way to do this. You can trade currency through online exchange offices called brokers. What this means is that you can exchange currencies online throughout the day and take advantage of the constantly fluctuating exchange rates. Just as in the example of when you went on holiday, you can buy different currencies and make a profit as the exchange rates change. This is trading the Forex market. Trading Forex online with a broker has many benefits. You can trade Forex from your home or anywhere that you have an internet connection. The Forex market never sleeps. It is open 24 hours a day, 5 days a week, and so can suit your daily routine. You do not need a huge budget to get started. As little as $150 is enough to begin trading and building your account over time. Of course, it will require some learning until you get there, but this is exactly what Tradimo is here for. To help you learn how to trade in a way that can suit your individual lifestyle, and to help you navigate your way through the Forex market.
Welcome on board, ladies and gentlemen. My name is Tavona, and I would like to just welcome everybody into the house. I hope you enjoyed the little video, the short animated video that I shared with everybody right at the beginning of this video, just to animate things for us to understand better what we are talking about. Okay, so ladies and gentlemen, I need you to fasten your seatbelts as we roll out the contents for today, and we want to get started to look into everything that has to be discussed tonight in terms of the speculators, the traders ourselves, where we come in, where the banks come in, and where this market is coming from and where it's going. After this, I tell you, you will realize that you made a very good decision to educate yourself. This will give you financial freedom in no time. Investment in education is the best thing. So I'll let somebody out there, tell them to visit our website at www.capitalmarket.com www.isisekelo.co.za. We are trying to help everybody realize that this opportunity, you really don't need a license, you just need to invest in yourself. Let's fasten our seatbelts as we get into today's lesson, ladies and gentlemen. Forex market is designed in a way that can fool most people, or most of the time. And on top of that, this market is the least understood market, yet it impacts our lives each and every single day. Whether we are buying or selling, everything will have been influenced by the Forex market. Now, to explain further, let's say you want to travel to the USA from South Africa. You will have to change South African rands to US dollars prior to your travel, either at the airport or just before you go to the airport. This is the broad principle of the foreign exchange markets that I'm trying to explain. It doesn't matter whether we are traveling or whether we are buying products from overseas, or we are simply using commodities like fuel, gas, oil, or buying, shopping, importing products in some shops. Everything has been influenced by foreign exchange rates between countries around the world. Every country in the world has its own currency. Now, what is foreign forex trading? It is short for foreign exchange trading, where one country's currency is quoted versus another. Countries or governments, including companies, they first agree on the right of exchange between their currencies. The forex market is not a centralized exchange, and it's not regulated. As a result, all trading is over the counter. The forex market allows business investors and traders to capitalize on the change in currency rates by taking what I call a view, or what is known by others as analysis, on the potential future direction of a currency against another. Therefore, all currency rates are quoted in pairs. Foreign exchange is therefore a financial market where you as a trader makes an analysis on the potential direction of a quoted price. So, if you are correct in your analysis, you will make money. But if you are also wrong in your analysis, well, you will lose money. So, this brings about a question that I'd like to answer today. Why do we have the forex market? Well, the main purpose is to provide easy, straightforward, and transparent way to allow businesses, to allow banks, to allow governments, to allow countries to convert from one currency to another easily and quickly for international trade purposes. In other words, without Forex, it would be so difficult to do international trading. Let me try to talk about the features of the Forex market to try to highlight what it looks like. It is the largest financial market in the world. I always say we have around $9 trillion daily to be traded. The liquidity provided is so huge. It is bigger than stocks and bigger than all the other markets except the bond market. This modern exchange rate system of today was created back in the 1970s when countries moved away from what we call free floating exchange rates from the previous fixed rate system. Under the fixed rate system, exchange rates were pegged using an artificial system known as Bretton Woods. Bretton Woods, it is where the currency was pegged to the fixed price of gold per ounce. Now, following the collapse of this Bretton Woods agreement in the 1970s, the US dollar was established as the main global reserve currency. The US dollar is the most widely held currency by banks around the world. The US dollar is regarded as extremely safe currency. This market is always open 24 hours every single week, 5 days per week, with weekend trading still open for cryptocurrencies. Hence, the liquidity that is provided has moved from 3 trillion to 9 trillion somewhere. The market is always open no matter where you are from. Whether you are a student on a full-time study arrangement, or you're on a full-time job, or you live in any other country that is not where we are, you can still trade because the market is always open anywhere in the world. Now, I want to illustrate a cycle of the market. How does it operate in the world? I'm going to give you an illustration from your screen. Just pay attention from the right side to the left side. I want you to see how this operates. And mind you, Sunday and Saturday, there is no trading for currencies. Now, here you can see the cycles of the market moving from one major trading center to another, moving from right to left. The first market to open is New Zealand. Now, when New Zealand opens, it's followed by Sydney, which opens at 10 p.m. GMT. Two hours later, Tokyo opens along with Hong Kong. Then they trade together until 7 a.m. GMT. When the European Forex market opened with London following an hour later, as a result, we have the best liquidity. Moving from Tokyo, we see the European market together with the UK market opening an hour later. Here, we see the best time to trade. When the Asian market closed, the UK and the European market trade together until the open of the New York market at 1 p.m. GMT. At this time, we have three major markets trading together for 2-hour period before Europe closes at 3 p.m. GMT, followed by the UK at 4 GMT, leaving only the US market trading alone until the New York market closes at 9 p.m. GMT, and the cycle repeats itself with Sydney opening again. You can note that heavily traded currencies do not stay heavily traded all day. In other words, a currency that is heavily traded in the London session is not traded heavily during the Tokyo session. Let me show you what happens in the Forex sessions. Let's start with Tokyo session, shall we? Now, during the Tokyo session, you'd find that the yen dominates much of the session. You will see that if we talk about percentages, the yen is going to be bullying others by a share of 78%. Therefore, in Tokyo session, 78% of all trading is in the US yen, which is dominating the Tokyo session. And 15%, only 15% is traded in the euro US. And 5% is traded on the euro yen, representing 98% of all trading. But if you move to London session, the case is different. When the London session opens, 39% is traded in the euro US dollar, then the pound US dollar is going to be traded with 23%. Then the US yen with only 17%. As I was saying, you can see the shift on the heavily traded currencies occur during different sessions. As each session moves on, the focus also shifts from one currency to another. As you can see in Tokyo, the attention is heavily laid upon Japanese yen. Yet in the euro, only the euro in London, only the attention moves a little bit to pound and euro and dollar. Attention moves away and shifts to the euro and the pound. And as for the markets, when they shift to the US, the focus shifts from this US dollar and pound, everything shifts to the dollar. Now, there are 5 main groups in the Forex market, and each has a very different trading objective and strategy. It is very important to understand what they all do so you can understand what drives the prices and why Forex markets react. First, we have market makers. These are the only non-customers, and they are there to provide a service to their buying clients. In general, I can say these are the major retail banks. So these international banks are the only organizations that are large enough to manage the multi-billion-dollar transactions involved in the corporate world. And in fact, they are the ones that create the market prices that are quoted daily. Then after the market makers, we have another special group that we need to pay attention and focus to. These are large corporate companies. These are the bread and butter of the Forex world, because this group, they require large currency exchange for real business purposes. They import, they export, they buy things, they sell things. So they are going to be moving the market a lot. We also have a special group that we need to pay attention to, the speculators. These are the group that really don't rely or require to handle the physical currency. They don't need the tangible currency in their hands. They are speculators. They only are interested in betting or analyzing the market, speculating the direction of the currencies, thereby making profits by the exchange of those exchange rates. There's a special group after the speculators that we need to pay attention to, and I simply call these ones the central banks. Now, the group of central banks, they are not keen, they really don't like for speculators to be speculating their currencies. Therefore, the central banks around the world, what they do is they come in the market and try to manipulate the market in a way that speculators will be confused as to matters of direction, because central banks of the world, they really don't want any currency to be speculated. If one says today the dollar is weak, we are going to be selling, this is what they don't want. They want the world not to know the direction of the currencies and pricing. So they are going to manipulate, they are going to try to do everything in the market. Anyway, we also have the last very special group that I'm going to talk about today. And this special group involves you and me. I'm simply talking about the small speculators. I've spoken about speculators. Those are hedge fund companies. They deal with big money. When they are trading, they're using big money to get big returns, but they also open up to big risk. But the small speculators is you and me. We trade in a retail way. When we trade, we only want to make profit. We're not going to handle the money, but we just want to know the exchange rates, the difference between this currency to the next currency, we make profit. So this is what I call the Forex market. I hope we have understood what this market is all about. I hope to see you in the next session as we enjoy together.